Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 112th CP program organized by WSP of ICI for this council year. It is our proud privilege that we are organizing various webinars as well as CP programs as well as programs in the form of physical mode. So this would be our 112th CP program, and we have covered all the auditing standards as well as all the auditing aspects, liability side as well as asset side of the balance sheet, various audit consideration while auditing the asset side as well as the liability side. Today we are having very important topic, that is the audit assertions. And in order to tackle this very important topic, we are having our learned guest speaker CA Harshvardhan Doshaji from Mumbai. So on behalf of WSB of ICI, I extend my warm welcome to our today's learned speaker CA Harshvardhan Doshaji. Namaste Harshvardhan ji. Welcome to you.
Thank you, sir.
Welcome to you Harshvardhan ji. Before we proceed and invite our today's learned speaker, it is my proud privilege to share with all of you the brief profile of Harshvardhan Doshaji. Harshvardhan Doshaji is a commerce graduate from University of Mumbai with a specialization in accounting and finance and a chartered accountant from Institute of Chartered Accountant of India. He has been in the field of auditing since last 6 years. After completing his articleship with C&K and Associates LLP, he continues to be a part of the audit and assurance team. Currently, C&K has total audit strength of about 500 plus staff members and has offices in Mumbai, Baroda, Chennai, Bangalore, Ahmedabad, Delhi, and Dubai. He specializes in the audit of service industries and foreign multinationals. He handles several large private limited companies and also handles statutory audit of listed companies. He also has experience in valuation and due diligence assignments. Harshvardhan Doshaji also has given various seminars, various training programs, various webinars, virtual CP meetings during the COVID time on various topics like company audits, standards on auditing, certificate assignments with the firm and at the Institute of Chartered Accountant of India, various forums of ICEI, and has been a part of the interim team of the developed working papers and audit documentation. He has also delivered lectures to CA final students and auditing and assurance. So list is very vast. If we find out the profile of our Harshvardhan Doshaji, so it is our proud privilege that he's today here on our 112th CP program organized by WSP of ICI. So without wasting much more time, I request Harshvardhan Doshaji to please enlighten all of us on various points on audit assertions. Over to Harshvardhan ji, please.
Thank you, sir. Thank you, Anilji, for the lovely introduction. And personally, I would like to thank you also because you have given me the opportunity to speak at the CA various CA boards all across India and even online. So thank you so much for the lovely opportunity. I will just share my screen and start the session. So. Friends and members, today's session is going to be on audit assertions. Now, when we talk about audit assertions, it may seem like a very vast word, or it may seem like something that we don't do on a regular basis. But as a matter of fact, audit assertion is something that we unknowingly we have been performing audit procedures to verify various audit assertions during our audit. Now, what happens is today when any audit goes for review or it gets picked up for review, we as auditors need to prove and we need to show that yes, we have performed such audit procedures, where documentation of audit assertions and documentation of procedures performed to verify various audit assertions is going to help us. So this is just a brief disclaimer that views expressed are not necessarily the views of the speaker. It does not. It is a dissuasive presentation and not conclusive. We are here to only share the knowledge. The agenda that we will cover today is first, we'll understand what is meant by audit risk, what are the various components of audit risk. After we identify what are the various components of audit risk, we will be understanding a few basic items from SA 315, because the word assertion and assertion level actually comes from the standard on audit 315. that is identifying and assessing the risk of material misstatement through understanding the entity and its environment. After that, we'll understand the various nature of audit procedures. What are the different types of audit procedures? What are the different nature of audit procedures that we will perform? After that, we will understand assertions for various captions of the financial statement. And what I will do is I will try to link the audit procedures for various assertions to what we actually present in the financial statement, along with what other audit procedures we do. But we may not be aware that these audit procedures is what we are doing for this specific assertion. Also, I will try and link the assertion to the reporting standard. So that will be helpful. And after we take up various captions in the middle, we will understand, we will take up a few case studies as well. Uh, along with taking up of case studies, and towards the end, we will understand a little on audit documentation, and with that, we'll come to a conclusion. So let us start with the first item on the agenda, that is audit risk. Basically, audit risk is the risk that as an auditor, we may provide an incorrect opinion on the financial statements. The risk usually deals with the fact that we provide an incorrect opinion in the sense we may issue a clean audit report where in fact there exists a material misstatement. The risk that there is no material misstatement in reality, but the auditor has still given a qualified opinion or an adverse or a disclaimer opinion, that risk is relatively very low. But yes, there is always a risk that we may issue a clean report where in fact there exists a material misstatement. So there are two components of audit risk. First is the risk of material misstatement, and second is detection risk. The risk of material misstatement is basically the risk that the financial statements are materially misstated prior to audit. See, understand today, because of n number of issues, it is likely that when management prepares financial statement and management provides us with financial statement, the financial statements may be materially misstated. Right? That risk of material misstatement may arise because of two reasons. First is the inherent risk, and second is the control risk. When we talk about inherent risk is due to the basic inherent limitations in an audit of financial statement or inherent limitations in the preparation of financial statement. Before we commence an audit, whenever management prepares financial statement, they may have various they may apply a lot of assumptions or estimates in the preparation of financial statement. All that gets covered in inherent risk. Apart from that, there is always a control risk that the company's internal control procedures may not be able to prevent or detect or correct any misstatement, whether due to error or due to fraud. Now, the one component of audit risk is risk of material misstatement, that the financial statements are materially misstated prior to audit. Another component is the detection risk. This is the risk that the audit procedures that we as auditors perform may not be able to detect or prevent any material misstatement, right? So, in essence, what we can understand is that risk of material misstatement is a risk that cannot be controlled by us as auditors. It can only be evaluated. However, detection risk is something that can be controlled by us. If we feel that the detection risk is high, then we can perform more audit procedures, or to a higher extent, we can perform audit procedures to reduce the detection risk in order to get the overall audit risk below that is acceptable to us. So audit risk is nothing but inherent risk into control risk and detection risk. Now, let us understand a little on SA 315, that is identifying and assessing the risk of material misstatement through understanding the entity and its environment. We just understood that risk of material misstatement is the risk that financial statements are misstated prior to audit. The objective of this standard on audit is to identify and assess the risk of material misstatement, whether due to fraud or due to error, at both the levels, at the financial statement level as well as the assertion level, via understanding the entity and its environment, including the entity's internal control. And once we identify and assess the risk of material misstatement is what gives us the last point, that is providing a basis for designing and implementing responses to the assessed risk of material misstatement, right? Basically, to tell you, in SA 315, we have to identify and assess the risk of material misstatement at both levels, the financial statement level as well as the assertion level. When we talk about financial statement and assertion level, we will see the definition in the next slides. But the reason why we identify and assess the risk of material misstatement is so that it gives us a basis. Sorry, is so that it provides us with a basis to implement and design our further audit procedures. All right. So let us understand what we mean by financial statement level and assertion level. SA 315 defines assertions as representations by management, explicit or otherwise, that are embodied in the financial statement as used by the auditor to consider the different types of potential misstatement that may occur. Now, coming to the start of our topic, that is actually assertions. Assertions is basically representations by management, either explicit or otherwise. Explicit in the sense that management would tell us explicitly that yes, we confirm these assertions on the financials, or otherwise in the sense it may be implied or it is embodied in the financial statements. It is already included in the financial statements, which will be used by us as auditors to consider the different types of misstatement that may occur. Just to give you a basic example, if the management provides us with let's say if the management provides us with sales of provides us with financial statements in which the sales is recorded at rupees 10 crores, so management is formally asserting to us that the sales that has been recorded of rupees 10 crores is complete, that the sales of 10 crores that has been recorded is the sales of the particular entity, that the sales of 10 crores that is recorded has actually occurred, it is genuine in nature, and it is accurately recorded in the books of accounts. So that is what we mean by assertion. See, it is not that management will tell us explicitly that, oh, when we tell you that sales is 10 crore, that 10 crore is actually occurred and 10 crore is the actual sales of the entity and 10 crore is accurately presented. It may also be implied. Also, there is one such thing known as negative assertion. For instance, when the management provides us with the financial statements and management does not include any property, plant, and equipment, it is the management is negatively asserting that there is no property, plant, and equipment in the company's balance sheet, that the company does not have any property, plant, and equipment, so that it does not need to record any property, plant, and equipment. So assertions can be in the positive form as to what appears to us in the financial statement, and in the negative form when nothing is shown in the financial statements or in the books of accounts. So that is what we mean by basic assertions. The financial statement level, when we talk about financial statement level refers to the level that relates pervasively to the financial statement as a whole and potentially affects many assertions. So like we understood in risk assessment procedures, like we understood that risk of material misstatement, it has to be identified at both the financial statement level as well as the assertion level. Financial statement level is basically that level that affects financial statement as a whole pervasively, and in fact, it may impact many assertions as part of our audit. And assertion level refers to the specific assertion of specific areas of the audit. So let us understand in detail what are the various types of assertions. The types or categories of assertions have been divided into three parts. First part is assertions about classes of transactions and events for the period under audit. There are 5 assertions, as we can see: occurrence, completeness, accuracy, cutoff, and classification. Occurrence assertion tells us that transaction and events that have been recorded have occurred and pertain to the entity and are genuine in nature. That yes, these transaction and events have in fact occurred and they pertain to the entity itself. Now, when we talk about classes of transactions and events for the period under audit, this actually talks about sorry, this actually talks about the what do you say, the sales that has been recorded or any item in profit and loss that has been recorded for the period under audit, means statement of profit and loss. There will be another class of assertion which will be for the balance sheet items. Here we are talking only about those assertions which relate to the profit and loss items. Second assertion for profit and loss item is completeness, where it says that all transactions and events that should have been recorded have in fact been recorded. So like I said, like we gave the example of sales of 10 crore. When sales in the financial statements is presented at 10 crores, management is asserting to us that yes, the sales of 10 crore has actually occurred. Sales of 10 crore is complete. Third assertion is accuracy, that amounts and other data relating to recorded transactions and events have been recorded appropriately. That sales of 10 crore, which has been accurately recorded by the entity, right? Next is cutoff transaction. Cutoff means transactions and events that have been recorded in the correct accounting period. Knowingly or unknowingly, what we do is we bifurcate or we segregate current expenses into prepaid expense and current year's expense. So why do we do that? Because in the current year, the items that should impact my profit and loss account should only be those events which relate to the current accounting period. So cutoff relates to those items that the transactions that have been recorded relate to this accounting period only. It does not relate to the next accounting period or in the previous accounting period. Also, classification. The transactions and events have been recorded in proper accounts and have been classified appropriately. So these are the basic assertions for P&L items. When we talk about P&L items, there would be occurrence that the item has occurred. In our example, sales of rupees 10 crore, that sales has actually occurred. Completeness, that sales of 10 crore is complete. There is no item that has been missed out. Accuracy, sales of 10 crore is accurate and it is accurately recorded. Cutoff, sales of 10 crore relates to the current accounting period. Here we take into account AS9, that is revenue recognition, which talks about timing of recognition of revenue. And classification, that sales has been appropriately classified as sales and it should not have been classified as other income. So that way, these are the assertions about classes of transactions and events for the period under audit. Next assertions, we talk about assertions about balances at the period end. Balances at the period end refer to nothing but the balances that appear in the books of accounts or the financial statement, which is nothing but the balance sheet items. Now, when we talk about balance sheet items, first assertion that we can check is existence. So let's take a basic example of fixed assets. Existence means that assets, liabilities, and equity interest actually exist. So if the entity is showing us fixed asset of 100 crore, entity is telling us that fixed assets of 100 crore actually exists. All right, you can physically touch the fixed assets; they actually are existing. Rights and obligation. The entity holds or controls the rights of assets and liabilities, and are the obligation and the liabilities are the obligations of the entity. So here, when the entity shows us or tells us that the fixed assets are 10 crores or 5 crores, the entity is telling us that yes, it is the rights of the entity. The entity controls this particular asset, and the liabilities are in fact obligation of the entity. Completeness, like we discussed, completeness means that all assets, liabilities, and equity interest that should have been recorded have been recorded. There are no incomplete items. So, if the fixed assets are shown as 10 crore, what the entity is telling us what the entity is implying to us is that all the assets which have been recorded totally amount to the valuation of 10 crores. Valuation and allocation. Assets and liabilities and equity interest are included in the financial statement at appropriate amounts, and any resulting valuation or allocation adjustments are appropriately recorded. That the assets and liabilities have been valued appropriately. Now, when we talk about valuation, we take into consideration for inventory, we would take into consideration AS2. For property, plant, and equipment, we would take into consideration AS10. For things such as debtors, we take into account provision for doubtful debts, and so on. So there, in that situation, we check whether the valuation and allocation has been properly done. These are assertions about account balances at the period end. Third, there are various assertions even about presentation and disclosure. The assertions are divided as occurrence and rights and obligation, completeness, classification and understandability, accuracy and valuation. Occurrence and rights and obligation are say that the disclosed events, transactions, and other matters have been occurred and in fact pertain to the entity. Completeness talks about that all disclosures that should have been included in the financial statements have been included. So when management is providing us with the financial statement and management prepares the notes to accounts, management is telling us that look, whatever disclosures were required have been presented appropriately in the financial statement. This would also include the additional disclosures that are required as per Schedule 3. When we look at the various items, when we are going through the various items of balance sheet and profit and loss account, we will also look at the additional disclosures which are required by Schedule 3, which we as auditors need to verify whether these disclosures have been recorded or not. Next is classification and understandability, that financial information is appropriately presented and described and disclosures are clearly expressed. See, ultimately, the aim of having any disclosure in the financial statement is that it has to be understandable to the users of the FS. Now, unless the information is not clearly expressed, it may not be understandable to the users. Next is accuracy and valuation, that the financial and other information are disclosed fairly and at appropriate amounts. So these are the various types of assertions about classes of transactions, assertions about balances at the period end, and assertions about presentation and disclosures. Next item on our agenda was the various types of audit procedures. So let us understand how audit procedures are divided. First, when we commence any audit, we will undertake risk assessment procedures. Now, what do we mean by risk assessment procedures? These are the audit procedures to identify and assess risk of material misstatement. The conduct of risk assessment procedures comes from SA 315, where SA 315 tells us that we have to identify and assess risk of material misstatement, where we perform risk assessment procedures to identify and assess the risk of material misstatement at both the financial statement level as well as assertion level. Once we complete performing risk assessment procedures, we move on to further audit procedures. These further audit procedures get covered in SA 330, that is auditor's responses to assessed risks. The risk that the auditor has identified in risk assessment procedures, for those risks, what are the audit procedures the auditor is going to perform? That is covered in SA 330. Now, SA 330, further audit procedures talks about test of control and substantive procedures. Test of controls are audit procedures that we perform to evaluate operating effectiveness of internal controls, to verify whether the internal controls are sufficient to identify any misstatement at the assertion level. Similarly, substantive procedures we conduct for various classes of transactions and for various balances and disclosures to check whether each assertion has been satisfied or not satisfied. Under substantive procedures, we conduct test of details and analytical procedures. There is often a misconception that test of controls need to be conducted only if reporting on internal financial control is applicable to the entity. However, that is not the case. Test of control forms part of your audit procedures. Irrespective of whether reporting on IFC is applicable or not applicable, we as auditors need to perform test of control, because in extremely rare situations can we say that only substantive procedures will be sufficient for us to obtain sufficient appropriate audit evidence. That will most likely never be the case because of the size of entity and the fact that we will always be performing sampling procedures. If we are performing sampling procedures, it is crucial and it is important and is mandatory that we perform test of controls as well. Without test of controls, we cannot move on to substantive procedures. Now, coming back to the topic of assertions and audit assertions, we undertake or we perform risk assessment procedures to, sorry, at the financial statement level, and we connect that to what can go wrong at the assertion level. So, in risk assessment procedures, like we said, we identify and assess the risk of material misstatement. That is the risk that financial statements are materially misstated before we actually commence the audit. Now, let's take a very basic example. Let's say, for instance, the company or the entity does not have any maker checker system present. Now, when the entity does not have any maker checker system present, from the financial statement level as a whole, because of maker checker system, the transactions that are recorded and the balances that are recorded can be completely inaccurate. So it will impact a lot of areas in the financial statements. Now, because the company does not have any maker checker system, we need to identify, due to this absence of maker checker system, what can go wrong individually at the assertion level. For instance, if we can say that if maker checker system does not exist, then the person recording the transactions can record incorrect transactions, which will be approved and which will be recorded in the and which will be disclosed in the financial statements. So the accuracy can be incorrect. Another example of risk assessment procedures can be that there is no sufficient segregation of duty. If there is no sufficient segregation of duty at the financial statement level, the auditor needs to identify if there is no sufficient segregation of duty, what areas will this impact? Where is there a possibility that the company or the management or the employees can actually do a fraud or an error without it being noticed? So, once we identify these areas, for these areas, what can go wrong at the individual assertion level? Individual assertion level, in the sense, for occurrence of sales, what can go wrong? For accuracy of sales, what can go wrong? For completeness of sales, what can go wrong? So we as auditors need to relate our risk assessment procedures at the financial statement level to what can individually go wrong at specific assertion levels. Apart from risk assessment procedures, when we perform our further audit procedures in accordance with SA 330, we perform two things: test of controls and substantive procedures. If, like you can see on the screen, test of controls and substantive procedures both are performed at assertion level only. So when we perform test of controls, the audit procedures that we apply should be applied to test a specific assertion about any class of transaction. Similarly, when we do vouching or verification, they should be applied to verify specific assertions about class of transaction or specific assertions about balances at the period end. Now, there can be a lot of audit procedures that we will apply, and coherently or inherently we have been applying those audit procedures. It's just that we may not have been able to relate it to the specific assertion, that all right, if this is the audit procedure that we are applying, we are doing this particular audit procedure for verification of this specific assertion. And as auditors, we also need to note that there can be a lot of mixture of audit procedures. Same audit procedures can be applied even to different areas of the entity. All right. So this was the basic about audit assertions. Let us move on to assertion on various captions of the financial statement. Starting with the first point, that is borrowings. Just one second. Yeah. Starting with the first point, that is borrowings. To verify existence assertion of borrowings, that is, the borrowings actually exist on the balance sheet date. These are the audit procedures that we will undertake. First, we will review the board minutes for approval of new lending agreements. During the review, make sure that any new loan agreements or bond issuances are authorized. Usually, when a company will obtain new loans or new borrowings, it will be approved in the minutes in the board meeting. So we as auditors will need to review the board minutes to understand if there is any new lending agreement. Also, ensure that significant debt commitment should be approved by board of directors. Next, agree the details of loans recorded, that is interest rate, nature and repayment, to the loan agreement, which means for every loan that the entity has obtained, we need to obtain a loan agreement. Once we obtain a loan agreement, we need to agree the details of loan recorded to the loan agreement. Also agree the overdraft and loans recorded to the bank confirmation or confirmation to lenders. We'll understand the confirmation procedures in some time. Examine the trust deed for terms and dates of redemption, borrowing restrictions, and compliance with covenants. Compliance with covenants is nothing but compliance with any terms or conditions of the loan. So if any terms or condition of the loan have been not complied with or have been broken, in that situation, a particular long-term loan may suddenly become short-term. So we need to identify and assess the compliance with covenants as well. Also, when the debt is retired, ensure that a discharge is received on the assets securing the debt. These audit procedures we will undertake for verification of existence of borrowings. Apart from that, we will also undertake direct confirmation procedures. Now, the guidance for direct confirmation procedures is given to us in SA 505 external confirmations. For the direct confirmation procedure, ascertain that the confirmation asks for all the information likely to be relevant to a test of debt and related interest balances. Generally, what we've observed is many times only in external confirmation for borrowings, only the outstanding amount is being confirmed. We can also confirm the interest amount and interest balance payable. So when you are designing your external confirmation request, to identify whether interest liability also exists on balance sheet date, also obtain the confirmation on interest balances. Mail the request under our control to a person within the lending institution who would be expected to be knowledgeable about the client's obligation. And if there have been if there are no replies which have been received, then send regular reminders or at least 2 reminders for non-replies. And compare for those replies which we have received, compare those replies received with to the request that we have shared with them, and reconcile the balances. So we need to ask the management to reconcile balances if there are any differences. These are the audit procedures. And you see, we perform external confirmation procedures. We perform review of board minutes, but we don't link it to existence assertion. So this is where this session is going to be helpful, where we will link all the audit procedures that we perform in general to which specific assertion it relates to. Next assertion is the completeness assertion. The procedures for completeness assertion is to obtain a schedule of short-term and long-term borrowing showing beginning and ending balances and borrowings and repayments during the year, and perform the following. Now, before we move on to the following procedure, many times what happens is clients, when we ask the client to give us a schedule of whatever the long-term borrowings are there or whatever the short-term borrowings are there, the client simply give us the extract of ledger account. Please don't accept an extract of ledger account as a schedule of short-term and long-term borrowing. Ask the client to separately, specifically prepare a short-term and long-term borrowing schedule showing us the beginning balance, ending balance, the repayment during the year, the additional borrowing taken during the year. Ledger account is an item with which we'll be reconciling this particular schedule. So both the bases can never be same. Consider any evidence of additional debt obtained through examination of minutes of the board and significant contracts or confirmations of bank account and support for subsequent cash disbursements. So any minutes of board of directors, any significant contracts that have been entered, when we obtain balance confirmation from bankers as part of our external confirmation, ask them also for any borrowings that the company has obtained. Even though there is no borrowings in the balance sheet of the company, as part of audit procedure, whenever we take confirmation from bank, we can ask for the loan balance. The maximum that the banker will do is say that there is no loan balance and confirm the nil balance to us. Next, test the summarization and trace the ending balances to the general ledger. So you see, because we have to test the summarization and ending balance to the general ledger, our general ledger cannot be the base for and cannot be called a schedule of long-term or short-term borrowings. Both need to be separate, and then you need to reconcile the two. Review the debt activity for last few days before and after the end of the reporting period to determine if there are any unrecorded liabilities at the year end and the transaction is recorded in the correct period. So this can also be done by simply verifying the bank statement. If in the last few days of the banks, if there is a reconciliation item in the bank statement, then we will come to know that something has actually been received but not been recorded in the books of accounts. So verification of bank statement becomes crucial in this case. Next assertion is valuation of borrowings. The procedures that you will apply for valuation of borrowings are: determine that the accounting policies and methods of recording debt are appropriate and applied consistently. Agree the loan balances and loan payables to the loan agreement. Usually, whenever it is a term loan, the banks or the financial institution will usually give a schedule where monthly repayments have been mentioned. So whatever is the closing balance should have been the closing balance as per the loan agreement. Reconcile that to what is the actually appearing in the books of accounts. Then recalculate the interest accrual and discount or premium on redemption. Check the computation for amortization of premium or discount. And for foreign currency loans, not foreign current, for foreign currency loans, agree the closing exchange rate used, and test for translation circulations. So we can check the closing exchange rate and verify whether AS11 has been complied with or AS11 has not been complied with. And for presentation and disclosures, for borrowings, presentation and disclosure becomes a little important, because not only do we have to check whether the disclosure for specific borrowing is complied with, but we also need to check whether the same is short-term or long-term in nature. Read the provisions in loan and debt agreements and perform the following. Test that the client is in compliance with loan covenants and other significant provisions of the agreement. This is because if the client is not in compliance with loan covenant, sometimes the debt may be repayable on demand automatically. So in that situation, you cannot now continue showing the borrowing as a long-term borrowing. We may need to change the classification to current. Second point says, if there are any provisions with which the client is not in compliance, determine whether the debt should be classified as current, like the example I just said. Next, examine the due dates on loans for proper classification between long-term and current loan, where installments of long-term loans falling due within the next 12 months have been disclosed in the financial statement. In the next slide, we will understand that there was a small change in Schedule 3, because of which earlier it used to be disclosed somewhere else. The repayment in the next 12 months used to be disclosed somewhere else. Now it will be disclosed elsewhere. Review the debt for related party transactions or borrowings from major shareholders. Now, here we need to review this debt from related parties, not only from presentation and disclosure perspective, but also from reporting perspective. If CARO is applicable to the entity, then we need to report these items in our CARO report. Further, for AS18 disclosure, also we need to check if any related party transactions have been done. In case the value of security falls below the amount of loan outstanding, examine whether the loan is classified as secured only to the extent of the market value of the security. So the loan will automatically become partially secured and not fully secured. Uh, examine the purpose for which the amount is borrowed and the amount is not used against the interest of the company. So see, the last point for presentation and disclosure covers two things. One, if the loan is not, if the amount borrowed is not used for the purpose for which it was taken, then there is a separate reporting required in CARO. Further, the management also has to report in its financial statements, right? And also, if the amount is not used against the interest of the company, as part of section 143(1), duty of auditor to inquire into certain matters, this is one of the matters, whether the amounts borrowed have not been used against the interest of the company. Continuing with presentation and disclosures for borrowings itself, under short-term borrowings, the following entries will be have been inserted in the amendments. Current maturities of long-term borrowing shall be disclosed. So earlier, the current maturities of long-term borrowings were shown under other current liabilities. Now they are separately to be disclosed under short-term borrowings. You see, as part of our financial statement audit, we would always verify the financial statement, and we would always identify whatever disclosures have been missing and the disclosures have been made or not been made. Now, what we need to do is we also need to document that we have verified these particular disclosures, and these were the additional disclosures that we had asked the management to make in the financial statements. Next point is that because of the amendment in Schedule 3 recently, the company is required to disclose if any borrowings from banks and financial institutions has not been utilized for the specific purpose for which it was taken at the balance sheet date. The company shall disclose the details of where have they been used. So this is a specific requirement of Schedule 3. So as auditors, we need to verify whether Schedule 3 requirements have been disclosed or not disclosed. Additionally, enhanced disclosure for borrowings from banks or financial institutions on the basis of security of current assets. Whether quarterly returns or statements of current assets filed with the company by the company with the banks or financial institutions are in agreement with the books of accounts. If not, summary of reconciliation and reasons for material discrepancies have to be disclosed. So, as auditors, we need to verify whether this particular item has been disclosed or not. Not only do we have to verify that these items have been disclosed, in CARO reporting, we have to separately report as well whether these items have been disclosed. There was this one more additional point of disclosure that we need to verify at the time of verifying presentation and disclosure. When the company either advances loan or when the company receives loan to any person or from any person, with an understanding that the intermediary company shall directly or indirectly lend or invest to other person on behalf of the ultimate beneficiary, or provide any guarantee on behalf of the ultimate beneficiary. And if that is the case, then the company needs to disclose these four items, right? So here, our responsibility is to the extent of checking in when we verify our audit, when we do audit of assertion. Our responsibility out here is to verify that the company has disclosed these items or not. First, the company will need to disclose these items. Based on the disclosure, we will perform our audit procedures. Also, the company needs to disclose where a company is declared willful defaulter by bank or financial institution or other lender. The following details need to be given: the date of declaration as willful defaulter and the details of default. So if the company has been disclosed, or if the company has been declared a willful defaulter by any bank or financial institution, the company has to disclose in the financial statement, and we as auditor need to verify this assertion. Like I said, what we will do is we will try to link the assertions to the disclosures in the financial statement to the reporting in our audit report. Now, in CARO 2020, there is an additional reporting in clause 3 B, clause 3 to B. So, in the new reporting requirement says whether during any point of time of the year the company has been sanctioned working capital limits in excess of 5 crore rupees in aggregate from banks or financial institution on the basis of security of current assets, whether the quarterly returns or statements filed by the company with such banks or financial institution are in agreement with the books of accounts of the company. If not, provide details. So here, this is the ultimate reporting that has to be done in CARO. And as part of CARO reporting, we may have already been verifying this particular item. But this item also, when we verify this item, we can also see that this item has been verified as part of presentation and disclosure for this enhanced disclosure out here. So that way we can link the procedures that we already perform with the assertions that we are supposed to verify. Next, for default and repayment of loans, as per CARO 2020, whether the company has defaulted in repayment of loans or other borrowings or the payment of interest thereon to any lender. If yes, the period and amount of default to be reported. Now, like we saw, same thing was the presentation and disclosure in the financial statement as per Schedule 3, and same thing is what we have to report in the CARO report. So here, again, we can relate the 2 points. Also, for diversion of loans, whether the term loans were applied for the purpose for which the loans were obtained. Like we saw in presentation and disclosure assertion, we were supposed to verify whether the term loans were applied for the purpose for which they were obtained or not. If not, the details have to be provided in the report. So first, if not, as auditors, verify whether the company has disclosed the same in the financial statements. Then come to the reporting part. First and foremost, it is crucial that the company has to disclose in the financial statement that yes, the term loans were not applied for the purpose for which they were raised, and accordingly you will need to change your CARO report. Term loans obtained from entities or persons other than banks or financial institutions are also supposed to be considered for this clause. Diversion would be examined as per the instances defined by RBI, and whether the company has granted loans to other parties, including related parties, or invested in other companies. In case a term loan has not been utilized for the purpose for which it is raised, then an auditor would report the amount of loan diverted and the purpose for which it is used. However, establishing a one-to-one relationship with the amount of term loan and utilization is not necessary. This was for the borrowings portion. After borrowing, we'll come to the trade receivables caption. Now, to verify the existence assertion of trade receivables, following procedures need to be performed. First, whether controls are in place to ensure that invoices cannot be recorded more than once. Now see, this whether controls are in place, this as auditors we already perform in risk assessment procedures. you relate the risk assessment procedures to what assertion you are verifying. So first we'll ensure whether there are sufficient controls in place so that same invoice cannot be recorded more than once. Next, period and accounts receivable aging report and trace the grand total to the amount in the accounts receivable in the general ledger. So we'll obtain a separate aging report from the management, and whatever is the total of the aging report, we need to reconcile or map with the general ledger account. Calculate the trade receivables total, add up the invoices on accounts receivable aging report to verify the total trades to general ledger is correct, like we just discussed. Also see whether realization is recorded invoice wise or not. If not, check that the money received from debtors is adjusted chronologically invoice wise and not on FIFO basis. So this is something that we need, and on FIFO basis, sorry. This is something that we need to verify at the time of, as part of existence assertion of trade receivables. Also, as part of existence assertion of trade receivables, where we want to identify that yes, this debtor exists as on the balance sheet date, we need to obtain direct confirmation procedures under as per SA 505. The direct confirmation procedure should necessarily be done for all significant account balances as at the period end, while certain random customers having small outstanding balance should also be selected. So for all the significant account imbalances, we should obtain direct confirmation definitely, but also do it for some random small customers, or maybe even for those customers with whom there have been no transactions during the year. Sometimes what happens is that there is opening balance outstanding and there have been no transactions during the year. It may so happen that there may be a case of dispute between the company and the customer. So that will come out when we try and obtain the external confirmation. The auditor employs direct confirmation procedure with the consent of the entity under audit. There may be situations where the management of the entity requests the auditor not to seek confirmation from the trade receivables. Now, sometimes it may be so possible that the management may tell us that for these few specific trade receivables, please do not obtain external confirmation because there may be some dispute, etc. As auditors, as part of our documentation, take the same in writing from management that management is telling us not to, and also obtain evidence which supports the management's claim that there is an ongoing dispute. And when we are checking that, automatically we can check the valuation assertion, wherein we can see that a required amount of provision has been created or not, and that the trade receivables have been valued appropriately. Lastly, any discrepancy revealed by the confirmations received or by additional tests carried out by the auditor may have a bearing on other accounts not included in the original sample. All right. This was the existence assertion. Coming to completeness assertion. In completeness assertion, basically we are trying to identify that all the trade receivables have been appropriately recorded in the books of accounts. When all the trade receivables have been appropriately recorded in the books of accounts, it automatically comes from proper procedures or proper controls for sales, because sales and trade receivables goes hand in hand. So if sales has been properly and correctly completely recorded, automatically it is given that the trade receivable will also be correctly recorded. So as part of the audit procedures for completeness, the auditor needs to satisfy himself of correct and proper cutoff procedures. Without correct cutoff, sales could be either understated or overstated. Now, for the purpose of cutoff, for invoices issued during the last few days closer to the reporting date, you can say around 5 to 10 days up to 31st March, cutoff date, and which have been included in the debtors, the goods have been dispatched and not lying with the company and included in closing stock. So these are just basic cutoff tests that we generally also perform. What we do is, for the last few days, we will check the invoices, and if any particular item has been included in debtors, we need to verify, we need to ensure that the goods for which this sales has been recorded has already been dispatched, and it should not be lying in the closing stock of the company. Then which would tell us that yes, the sales has been recorded and it's complete. Next, all goods dispatched prior to the period end or year end have been invoiced and have been included in the debtors. No goods dispatched after the year end have been invoiced and included in debtors for the period under audit. So if any goods have been dispatched after the period end, that is the risk and reward has been transferred after the year is over, then it should not have been included in the debtors. It should be recorded as revenue of the next accounting period. Also, test the invoices which are listed in receivables report. Now we are verifying the completeness. For that, select a few invoices from the accounts receivable aging and compare them to the supporting documentation to see if they were billed with the correct amounts to the correct customers on the correct dates. Now, this specific audit procedure for completeness that we see, we can also take the same audit procedure and verify accuracy of sales. So here there will be a linking between verification of a balance sheet item and verification of a profit and loss item. Match the invoices to shipping log or dispatch log. If there's a situation that the company is billing customers for sales despite still retaining the goods on site, known as bill and hold, examine the supporting documentation to determine whether a sale has actually taken place. Sometimes it may so happen that the customer asks the entity to hold the goods even though the risk and reward is transferred. For such a case, we need to obtain sufficient documentation and proper supporting, either via agreement or a confirmation from the customer, which says that yes, these goods have actually been, the risk and reward has actually been transferred. However, we have asked the company to retain the goods. Also, review credit memos, review selection of credit memos in the sense credit notes. Review credit notes to issued during the audit period to see if they were properly authorized. These are the procedures for completeness assertion. For valuation assertion, basic procedure is to assess the allowance for doubtful accounts if any debtor is considered as doubtful. This will include a consistency comparison with the method used in the last year and a determination of whether the method is appropriate for the underlying business environment. So first and foremost, what we generally do is we obtain the policy for provision for doubtful debts. Some entities say that more than one, if any debt is outstanding for more than 180 days, we automatically consider it as 100% provision. Another entity may say that if it's more than 365 days, we consider 50% provision. So, or some other entity may have specific provisioning for specific debtors. Whatever is the scenario, first we need to obtain the policy for valuation of doubtful debts. After that, also obtain the aging report of accounts receivable split between not currently due 30 days old, 30 to 60, 60 to 180, and so on. Also obtain the list of debtors under litigation and compare with the previous years. You see, if a particular debtor is more than 365 days old, it is quite likely that there needs to be created some amount of provision on the same. So we obtain the aging from the client, and when we obtain the aging from the client, perform analysis to verify if any debtor is outstanding for more than 365 days, whether the same have been considered for provision for doubtful accounts or not. Next, scrutinize the analysis and identify those debt which appears to be doubtful. Assess the bad debts actually written off and prepare a schedule of movement of bad debts. Check that the write-off or other reductions in the receivable balances have been approved by an appropriate and authorized member of the senior management. Here, when there used to be a lot of cash transaction, if there wasn't sufficient segregation of duty, there could be chances of fraud being conducted. So identify at the time of risk assessment, identify if there is proper segregation of duty or not. If there is no proper segregation of duty, it may indirectly impact the valuation assertion for trade receivables. Check that restatement of foreign currency trade receivables in this case, and check that the foreign restatement of foreign currency of trade receivables has been properly done as per AS level. After valuation, there is presentation and disclosure assertion. There is already an existing requirement to classify trade receivables into considered good secured, considered good unsecured, and considered doubtful. Allowance for bad and doubtful debt shall be separately disclosed under relevant heads. So for considered good secured, if there is any provision, it needs to be separately disclosed right under considered good secured. If for considered good unsecured there is any separate provision, it needs to be written right below that, and for doubtful, whatever is the provision needs to be written. Debts due by directors or other officers of the company, have any of them jointly or severally with any other person, or debts due by firms or private companies respectively, in which director is a partner or a director or a member, has to be separately stated. Now, this is a requirement that comes from companies, from Schedule 3 of Companies Act. We as auditors need to identify, and we as auditors need to verify whether this presentation has been appropriately done in the financial statements. Also, as per the latest amendment in Schedule 3, annual additional categorization also needs to be done. Just one second. So, as per the latest amendment in Schedule 3, the debtors are to be further subclassified into undisputed trade receivables, which are considered good, undisputed trade receivables, which are considered doubtful, disputed trade receivables, which are considered good, and disputed trade receivables, which are considered doubtful. And whether they are outstanding for the following period from the due date, less than 6 months, 6 months to 1 year, 1 to 2, 2 to 3, more than 3 years, and total. Now, here it is important to note that the outstanding date has to be taken from the due date of payment and not from the, sorry, and not from the date of transaction. However, where no due date of payment is specified, disclosure shall be from the date of transaction. Now, the total of this table ideally should also match with the total of trade receivables note. So in that scenario, what we generally can do is we can add one more column for debts which are not due, because it may be so possible that there are some debts which are not due. So those debts not due, for that we'll create a separate column, and then the total may match with the total as per the notes. That was for trade payables. That was for trade receivables. For trade payables, following disclosures are required. For existence assertion, following audit procedures are required. First, whether there are controls in place to ensure that the same purchase invoice cannot be recorded more than once, and payable balances are automatically recorded in the general ledger at the time of recording of purchase. Also ask for period and payable aging report and trace the grand total to the amount in the accounts payable in the general ledger. Calculate the accounts payable report total and verify the total trace from aging report to general ledger is correct. And investigate reconciling items. If the management is providing us with an aging report and the management is providing us with a general ledger, there should not be any difference between aging report and general ledger. If there is a difference between aging report and general ledger, there may be a problem of existence. That someplace in some particular scenario, the trade payable has not been captured. So we need to identify that. Also, for existence assertion, we will conduct direct confirmation procedures. First, the trade creditors may be requested to confirm the balances either as at the date of balance sheet or at any other selected date which is closer to the balance sheet date. The form of requesting may be either in a positive form or a negative form. The method and selection of trade creditors to be circularized should not be revealed to the company until the trial balance and payables ledger is handed over to us. Any discrepancies revealed by the confirmations received or by additional tests carried out by the auditor may have a bearing on other accounts which are not included in the original sample. So these audit direct confirmation procedures we need to perform as part of trade payables. This was for existence of trade payables. For completeness of trade payables, like we just did for trade receivables, for completeness, we need to check that purchases have been correctly or completely recorded. For that, we need to ensure that there have been proper cutoff of P&L item. So here, the auditor needs to satisfy himself of correct and proper cutoff for invoices received or recorded during the last few days closer to the reporting date or cutoff date, and which have been included in trade payables. Sorry. All goods received prior to the year end should have been booked in the form of purchases and included in creditors. Generally, if any good is received before the year end, the risk and reward has already been transferred to us. So, to the company. In that scenario, the company should record purchases, and it should not be that the purchases are not recorded, but the goods are recorded in the books. No goods received or risk and reward of ownership transferred after 31st March should be recorded as purchases. Search for unrecorded liability For unrecorded liability, review subsequent expense vouchers. Now, this is a very basic test that many times people don't conduct. For what? For verifying if there is any unrecorded liability or not. Also verify subsequent expense vouchers. So verify subsequent purchases made after 31st March, which have been recorded in first week of April or first 10 days of April, and check that did this particular purchase actually relate or actually belong before 31st of March. For advances received from customers or revenue received in advance, obtain customer-wise listing along with aging and nature. For valuation of trade payables, assess old outstanding liability balances and review the process followed by the company to identify if any old balance of creditors needs to be written back. And whenever a company is writing back any outstanding balance of trade payables, ensure that it has been properly authorized, right? Obtain the aging of trade payables split between so and so dates, and check that the write back in the liability balances assessed as no longer payable have been approved by an appropriate and authorized member of the senior management. It should not be approved by a junior accountant. Check that the restatement of foreign currency trade payables has been done as per ES level, and also understand the management's process to identify the principal amount and interest due remaining unpaid to any MSMED companies. Now, this is a very important point out here. We need to understand that how the company is identifying whether a particular vendor is an MSME vendor or not. Usually, at the time of vendor intake, the company may ask the vendor specifically whether it is an MSME or not. But if that is not happening, then identify and understand the process that the company is following to verify if a particular vendor is an MSMED vendor or not an MSMED vendor. For presentation and disclosure of trade payables, first, firstly, when we look at the face of balance sheet for trade payables, in the face of balance sheet itself, we need to check and we need to ensure that trade payables have been divided or segregated into two parts: total outstanding dues of micro enterprises and small enterprises, and total outstanding dues of creditors other than micro and small enterprises. So this bifurcation or this change is required on the face of balance sheet itself. Along with that, it will be included in the note. Now, for presentation and disclosure of trade payables, as per the new requirement of MCA, the following needs to be disclosed in the following manner: dues to MSME, dues to others, disputed dues to MSME, and disputed dues to others, outstanding for the following period from the due dates: less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. And of course, the total amount out here should be matching or should be reconciling with the total amount of trade payables appearing in the notes. Also, what we can do is we may need to create one more column like trade receivables. We may need to create one more column as not due out here, so that to ensure that the total matches with the trade payables note. Similar information shall also be given when no due date of payment is specified. In that case, disclosure shall be from the date of transaction. Also, points out here, two additional columns with the heading unbilled and heading not due shall be added. Unbilled due, which shall include accruals which are not classified as provisions under AS 29, only those will be counted out here as trade payables. In case no new date is specified, disclosure shall be from the date of transaction. Fine. This is just an extract of the disclosure that is required under MSMED Act. So you can just see out here that under MSMED Act also company needs to disclose some specific things. First, the amount remaining unpaid to any supplier at the end of accounting year, the principal amount as well as the interest due thereon, and the amount of interest paid by the buyer in terms of Section 16 of MSMED Act, along with amount of payment made to the supplier, and so on. I'll just give a couple of seconds to read this. All right. So as auditors, we need to verify and we need to ensure that these items are presented and disclosed appropriately for trade payables in the financial statements. We already finished this. So there is a case study or a question, and I would I would like it if we get answers in the chat box or somewhere. Uh, so the question is, if an auditor is unable to obtain external confirmation from debtors and creditors during the year and at year end, which assertion the auditor will not be able to verify? And to that, what are the alternative audit procedures that the auditor may perform, and what documentation shall the auditor maintain for not for being unable to perform external confirmation? Any answers in the chat box are welcome, please. All right. So, what assertion will the auditor not be able to verify if we do not perform external confirmation? The auditor may not be able to verify the existence assertion for external confirmation if he does not undertake external confirmation. So, you see, completeness will still be able to be verified also, but obligation of the entity, the auditor may not be able to verify whether the same balance is a right to receive the money or right to pay the money, the obligation of the entity. So right and obligation assertion, auditor will not be able to verify. Auditor will not be able to verify the existence assertion, right? What are the alternative audit procedures that the auditor may perform? Alternatively, if the auditor cannot obtain external confirmation, the auditor may perform checking of subsequent transactions, whether subsequently the amount has been paid or subsequently the amount has been received. Also, the auditor can check subsequently whether there have been any additional purchases made from the entity or additional sales made to the entity. Next, what documentation shall the auditor maintain? The auditor shall maintain as to why he was unable to perform the external confirmation, obtain the same from the management in writing, and obtain confirmation of whatever the management is saying. If the management is saying that yes, for with these debtors and creditors we had a particular dispute, then in that situation you obtain a confirmation and document it that yes, there actually was a dispute and this was the supporting for the dispute. So that is his first case study that we did. We finished with debtors and creditors. Now we move on to cash and cash equivalents. To verify existence and completeness assertion of cash and cash equivalents, first procedure is very basic, and this is something that we do, but to link it to assertion has not been happening. So here, whenever you perform surprise cash verification, document it, and when we document it, also document that with the surprise cash verification, we verified completeness assertion. So cash verification usually will be on the surprise check, usually will be by way of surprise check. It is not necessary to check cash only on the last day. And also all locations to be checked simultaneously. If the company has more than one location, then all the locations can be checked simultaneously. However, if the auditor is unable to check the cash balance on the last day of the balance sheet, as auditors, we can request the management that whatever is your cash on hand on the last day, please deposit in the bank account. So if they deposit on the bank account either on the last day or the first day of the next year, we have a record in bank statement that yes, this much cash was deposited, which we can check that obtain sufficient appropriate audit evidence that this was the cash existing on 31st March. As then we can also perform cash sensitivity analysis by compiling a summary of total cash receipts and payments each month and analyzing the trends to see if there have been any variation in any specific months and request brief descriptions from the management. The auditor needs to obtain, this was for cash. For banks, the auditor needs to obtain bank reconciliation statement for each and every, for all bank accounts maintained by the entity at the reporting end. Verification of BRS shall entail tallying the balance as per books with company's accounts and trial balance, very simple. Tallying the balance as per book also to the bank confirmation. What we usually see in documentation is that yes, bank balance has been matched with the books of account, but whether the bank balance has been matched with the balance confirmation or not, that is sometimes not documented for some reason. So that also you need to ensure that balance as per bank matches with the balance as per confirmation. Checking of all material reconciling items as whatever is your general bank reconciliation items. So such cases, if any case of reconciliation exists, please obtain reconciliations from the management as well. Also, as part of existence, we will obtain direct confirmation procedures. The auditor shall necessarily, the direct confirmation shall necessarily be obtained for all the account balances at the period end. For banks, it becomes very crucial because once we have bank confirmation and once we know that the balance at the year end is correct, the transactions which are impacting bank accounts, we can say that yes, those transactions are also partially correct, because at least the closing balance as per books of bank and closing balance as per bank statement is matching. So the transactions which were supposed to be recorded have been recorded. The company should be asked to investigate and reconcile the discrepancies. Also emphasize for confirmation of 100% of bank account balances, especially accounts with no transactions. You see, as part of verifying whether the bank balance still exists or no, many times we have seen that the company has a lot of bank accounts and there are a few bank accounts for which there have been no transactions during the year. And this has been the case in the last 2 years, 3 years, 4 years, that the company has no transaction with the bank, but the same balance has been continued for the last 2, 3 years. Especially for these accounts, obtain bank confirmation and ensure that the closing balance actually is there. What if the amount has been withdrawn and has not been communicated to us as auditors, or has not been passed in the books of accounts? For that reason, please ensure even for those accounts where there are no transactions, confirmation is obtained. In remote situations where no reply is received, the auditor should perform additional testing regarding the balances. This testing could include agreeing the balances to bank statement received by the company or internet online login of account in auditor's personal presence, or sending any audit team member to the bank branch along with the entity's personnel to obtain the bank confirmation. Next, for valuation, also just check that all bank accounts holding foreign currency have been restated as per the closing rate in compliance with AS 11. For presentation and disclosure, as per Schedule 3, we can verify that the cash and cash equivalents have been classified as balance with banks, checks or drafts on hand, cash on hand, and others. Any earmarked balances with banks need to be separately stated. Balances with bank to the extent held as margin money or security against borrowing shall be disclosed separately. If there are any repatriation restrictions in accordance with RBI guidelines or FEMA guidelines in respect of any cash and cash balances, the same shall be separately stated against that category of cash and cash balance. Also, bank deposits with more than 12 months of maturity shall be disclosed separately. That will not form part of cash and cash equivalents. This was the balance sheet caption for cash and cash equivalent. Coming to the next caption for inventory. First assertion is existence. Review the client's plan for performing inventory count. The plan shall include procedures relating to shipments and receipts during count, and also allocate staff responsible for each class of inventory. Now you see, almost every in fact every time we do the audit, or every year when we do the audit, wherever there is inventory, we do perform physical verification. That physical verification is also for one assertion, that is the existence assertion, whether the inventory actually exists as on 31st March or not. Now when we are performing that in physical verification, second point says ensure that consigned goods have been segregated. If I am a consignee, then my goods shall be separately kept and the consignor's goods shall be separately kept. Evidence of appropriate supervision for those performing inventory count should be examined. See, if we are going along with the management for performing inventory count, then we need to check that there is appropriate supervision by performing inventory count. It is not just that whatever is the quantity mentioned in the list, same has been written in the actual physical. Next, observe the inventory being counted and personally perform test counts to verify few counts. As auditors, we need to personally test few items of inventory. Test counts by the auditor should include observing employees are adhering to the agreed plan, assuring that all items are properly tagged, Every item should have a separate material code if possible. Observing that proper amounts are shown on the tags, and reconciliation of test counts with tags and summary sheets and discrepancies noted. Ensuring exclusion of third party stock. This is very crucial, especially in cases where there are shared go downs. So if there are shared go downs, in that situation, we need to check first as part of policy that the goods of different companies are differently kept. Of all the companies should not be kept in the same place. When the control risk is high or a client uses periodic system, inventory should be taken necessarily at the year end. And if the client uses perpetual system, inventory may be counted at interim dates instead of year end. Apart from existence assertion, sorry, for completeness assertion of inventory, we can perform the following procedures. First, we can perform analytical procedures to check whether what should be my closing balance or closing value of inventory. Either we can do inventory turnover ratio and compare with the balances of earlier years, or perform vertical analysis or compare the budgetary expectations vis-a-vis whatever were the actual inventories. Also examine non-financial information related to inventory such as weights and measures, especially in cases where there are like ingredients mentioned for foodstuffs and etc. Perform purchase and sale cutoff tests. Trace the shipping documents to accounting records immediately before and after year end. Verify clerical and arithmetical accuracy of inventory listing. Reconcile the physical inventory counts with the records, and reconcile physical inventory counts with the general ledger totals as well. Finally, whatever is the inventory that you have verified or that the management has verified as per the physical verification is what should be appearing in the books of accounts. For rights and obligations, now it is very simple. Rights and obligation in the sense that the inventory actually belongs to the entity, and the entity has right and title of the inventory. So for rights and obligation, it is simple that we need to vouch the purchases to the underlying documentation. Determine existence of collateral agreements. If the inventory is going to be kept as collateral or as a security or hypothecation or pledge with banks or financial institution, we need to examine such agreements. Review consignment agreements where what are my inventories with other parties as well. Also, review material purchase commitment agreements, examine invoices for evidence of ownership for inventory held by third party. Now, this is crucial for inventory held by third parties. For example, I am a consignor, I have a consignee, and my consignee is maintaining inventory for me, which is not yet sold. Insist on obtaining declaration from the third party in its business letterhead and signed by an authorized person of the third party, confirming that items of inventory actually belong to the entity and are just simply being held by such a third party on behalf of the entity. All right. So this becomes a crucial point that we need to maintain. For valuation of inventory, now see it's quite simple. We generally perform valuation of inventory and we verify that inventory has been correctly valued or not, and we do apply the procedures mentioned under AS2 and the principles of AS2. So for raw materials and consumables, ascertain what elements of cost are included. Sorry. If standard costing is used, inquire into what are the basis of standards, how these are compared with the actual cost, and how variances are analyzed and accounted for. Also, test check the cost prices used with the purchase invoices received in the months prior to counting. Follow up on valuation of damaged and obsolete stock. So if there is any damage or obsolete stock, same, there should be a provision for obsolescence made for such kind of inventories. For work in progress, ascertain how various stage of production or value are measured, ascertain what elements of cost are involved in work in progress, and ensure that material costs exclude any abnormal wastage factors. For finished goods, inquire into what costs are included, what are the items that get added to the cost of finished goods, how these have been established, and ensure that overheads included in the have been determined based on normal cost and appear to be reasonable. So here, usually whenever overheads are allocated to finished goods, they're allocated on the basis of some rate. So we as auditors need to verify how the rate was derived and what was the normal rate and what was the abnormal rate, if any. Ensure that inventories are valued at NRV if they are likely to fetch a value lower than their cost. For verifying whether inventories are measured at cost or whether inventories are measured at net realizable value, we can also check subsequent sales. So when we verify subsequent sales, we will automatically come to know in the future, is inventory being sold at a lower value compared to what is recorded in the financial statement. If so, you need to change the valuation, and we need to question the management as to why the inventory is still being valued at cost. Examine the vendor price list to determine if recorded cost is less than current prices. In manufacturing environments, test the overhead allocation rate and ensure that only direct labor and direct material and overhead have been included. All right. This was for valuation assertion. Presentation and disclosure of inventories is fairly simple. Whether mode of valuation has been stated separately for each class of inventory, that is either the inventory is being valued by FIFO basis or weighted average basis. Then whether inventory has been classified as raw materials, WIP, finished goods, stock in trade, etc. And whether goods in transit have been disclosed separately under each head of inventory. All these presentation and disclosure points are simply coming from Schedule 3. So Schedule 3 tells us that this has to be disclosed in such a manner, and we as auditors need to verify whether the management has disclosed it appropriately or not. We'll take up the case study questions towards the end. So all the questions, we'll do all the case study questions together. Next is property, plant and equipment. First assertion is the existence assertion for property, plant and equipment. Now see, in CARO 2020, we have to report whether the company has conducted physical verification of property, plant and equipment during the year. But it is not that we will conduct that particular verification procedure only for the purpose of reporting in CARO. As part of our audit of financial statement, also we need to ensure that the property, plant and equipment actually exists on the balance sheet date. So for that, review the client's plan for performing physical verification of PPE. Evidence of appropriate supervision of those performing physical verification should be examined, and obtain a PPE verification report backed by the working sheets from the client and perform the following procedures. Assess if all the items of PPE are properly tagged and carry identification marks or numbers, and physical verification work papers do capture the asset identification numbers for assets physically verified. Here, usually in case of service industries, whenever we have a lot, usually they will have a lot of laptops, a lot of computers, a lot of mobile phones. What we can also do is we can obtain which particular user is using the particular asset. When we obtain which particular user is using this particular fixed asset, it can mark that yes, this particular item exists on the balance sheet. What we can also do along with verifying, once the user is tagged to a particular item of property, plant and equipment, we can check that whether the user is still existing on the payroll register of the company. If the user has left the company, then there cannot be any property, plant and equipment on the name of the user. Sorry. After the physical verification is done, reconcile the items of PPE as per physically verified and as per the fixed asset register. Verify the discrepancies based on physical verification and the manner in which such discrepancies have been dealt with in the books of accounts. These were procedures for existence of property, plant and equipment. For procedures of completeness, for completeness assertion, basically completeness being that all the property, plant and equipment which was supposed to be recognized has actually been recognized in the books of accounts. So the first assertion is completeness. The procedures that you will undertake is verify if the movement in the property, plant and equipment schedule compiled by the management. Check the arithmetical accuracy of the movement in PPE schedule. Tally the opening balances to the previous year's audited financial statement. Now, this is something that we will anyway be doing as part of our opening tracing, that is verifying the last year's closing balances with current year's opening balances. For additions during the period under audit, obtain a listing of all the additions from the management and undertake the following procedures. For all material additions, verify if such expenditure meets the capital expenditure test. An item can be classified as property, plant, and equipment only if it is a capital expenditure as defined in AS10. If it is not a capital expenditure, then the same has to be expensed off. The cost of item of property, plant, and equipment shall be recognized as an asset if it is probable that the future economic benefits associated with the item will flow to the entity and the cost of the item can be measured reliably. That is as per AS10. The all this you will check for the additions which are being made for the property, plant, and equipment. For the deletions which are being made for the property, plant, and equipment, understand the rationale for the deletion of property, plant, and equipment. Also obtain management approval and discard note authorizing the disposal of the asset from its active use, and verify what is the process for disposal of the property, plant, and equipment. With this, we can verify the completeness of property, plant, and equipment. All additions have been captured, all deletions have also been captured, and whatever were the closing balances last year have been brought forward to the current year appropriately. For valuation, very simple. As part of our audit procedures, generally also we conduct depreciation. We check that depreciation has been properly recorded. So here, verify that the entity has charged depreciation on all items of PPE unless any item of property, plant, and equipment is non-depreciating, such as land. Verify that the depreciation method used reflects the pattern in which the asset's future economic benefits are expected. The auditor should verify if the management has undertaken an impairment assessment to determine whether an item of property, plant, and equipment is impaired. Impairment is nothing but a permanent, like a reduction in value of the entity when the recoverable amount of PPE is not much compared to the book value. So, especially in cases of factories, or especially in cases of machineries which have been built by the company, or machineries which have been purchased by a company which are existing in the fixed assets since a long period of time, we need to insist on the management to conduct an impairment assessment. Now, once the management confirms that yes, the asset need not be impaired, then as part of a valuation, we can close this audit procedure that yes, this particular asset does not need impairment. Verify if the entity has applied AS28 impairment of assets for determining the manner of reviewing the carrying amount of property, plant, and equipment, and determining the recoverable amount of the PPE to determine the impairment loss. For verifying rights and obligation, again, rights and obligation is nothing but right being whether the company controls the particular property, plant, and equipment. So, as part of the procedures, the auditor, while performing testing of additions, should verify that all PPE purchase invoices are in the name of the entity that entitles legal title of ownership to the respective entity. This will be done by itself when we perform vouching of FA additions. So generally what we see is that there is an audit procedure for vouching of additions, but that vouching of additions is actually covering two particular assertions. It is covering the completeness assertion, it is covering the existence assertion, and it is also covering the rights and obligation assertion. The auditor should insist and verify the original title deed of all immovable properties held as at the balance sheet date. In case the entity has given such immovable property as security for any borrowings, and the original title deed are not available with the entity, the auditor shall request the entity's management for obtaining a confirmation from the respective lenders. The respective lenders can confirm that the title deed is with them and not with the company. Next, for presentation and disclosure of property, plant, and equipment, the various procedures can be seen as follows. Basically, all the items of PPE need to be classified as land, building, plant and equipment, furniture and fixtures, vehicles, office equipment, or others. Also, if any asset is on lease, then it needs to be separately disclosed. For each class of property, plant, and equipment, generally also we show the gross block and accumulated depreciation. Apart from accumulated depreciation, we also need to show the impairment losses, if any. All right, so there will be gross block, accumulated depreciation, and impairment losses for each class of property, plant, and equipment. Along with that, according to the new Schedule 3 and new CARO requirement, there is a CARO requirement which says whether the company has revalued its property, plant, and equipment or intangible assets of both during the year, and if so, whether the revaluation is based on valuation by a registered valuer. Specify the amount of change if the change is 10% or more in the aggregate of net carrying value of each property, plant, and equipment or intangible asset. This is something that we as auditors need to additionally report in our auditor's report. But for that, first, the company needs to disclose this in the financial statements. So as per the revised schedule 3, along with showing the gross amount and the net carrying amount after depreciation, the company also needs to see, I'm just reading the red highlighted part, the amount of change due to revaluation if the change is 10% or more in the aggregate of the net carrying value for each class of property, plant, and equipment or intangible asset. So this has to be specifically disclosed in the financial statements of the company. Apart from that, where the company has revalued its property, plant, and equipment, the company shall disclose as to whether the revaluation is based on valuation by a registered valuer. So you see, as part of our audit report, when we actually prepare the audit report, we definitely verify this assertion of presentation and disclosure. But just while reviewing the financial statements and ensuring that all the notes are complete, also we are verifying this presentation and disclosure assertion. So this is something that we need to keep in mind. Further, there is additional requirement that whether the title deeds of all immovable properties disclosed in the financial statements are held in the name of company. If they are not held in the name of company, these details need to be mentioned in the CARO report. So that needs to be checked. Again, similarly, even though it is there in CARO, this also has to be disclosed first in the financial statements of the entity, where the company has to disclose that whether the title deed of immovable property is held or is not held in the name of the company. And if it is not held, if there is any dispute or something, we need to mention what is the reason for the title deed not being held in the name of the company. As part of property, plant, and equipment, it also covers capital work in progress and intangible assets. For capital work in progress and intangible assets under development, the following aging schedule needs to be given. Now, this is a requirement as per the new Schedule 3. Whether basically the projects in progress and projects temporarily suspended, what is the amount in capital work in progress under development for a period of less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. And this needs to be disclosed in the financial statement. Also, for capital work in progress whose completion is overdue or which has exceeded its cost compared to the original plan, following CWIP completion schedule needs to be given. Basically, whenever any capital work in progress whose completion is now overdue, it was supposed to get over in the current year, but it has not gotten over in the current year, it's overdue, or the cost has exceeded to the plan or to the budget. In that situation, we need to give project-wise breakup of in how long is the same expected to be completed. All right. So this also needs to be additionally disclosed in the financial statements. Further, the company needs to disclose details of any Benami property, that is whether any proceedings have been initiated or are pending against the company for holding any Benami property against under Benami Transaction Act. If that is the case, following details need to be mentioned. All right, questions again, we will take up the questions or the case study questions towards the end. So we'll come back to this. For loans and advances, verification of existence assertion of loans and advances, similar to how we obtain direct confirmation from debtors and creditors, we will also obtain from people to whom we have given the advances. But while obtaining direct confirmation for loans and advances, we can also obtain the interest portion, interest received or interest that is receivable. So that is an additional thing. For completeness of loans and advances, obtain a list of all loans and advances and other current assets and compare them with the balances in the ledger. Again, please obtain a separate list from the client, then what is the extract of the ledger account, because we need to compare that list of loans and advances to whatever is the actual ledger account. Inspect any loan agreement and acknowledge and acknowledgements of parties in respect of outstanding loans. Inspect the minutes of meeting of board of directors to confirm if material loans and advances were approved by board of directors. As part of verification of compliances, we as auditors also need to check whether section 185 and 186 of the Companies Act have been complied with. So in that, we need to verify whether board resolution was required, or a member's resolution was required, or a special resolution was required, and appropriately whether the same has been passed or not. Also verify that the loan has been acknowledged by the party, and in addition, inspect when the security has been deposited against due repayment of the loan. So if a company is giving a loan to another party, generally there would also be a deposit. Generally there would also be a security deposited by that party. So check whether the security is received by and is existing with the company or not. Related party loans and advances. If there are any related party loans and advances, review whether they were properly authorized and value such transactions, and the value of such transactions were reasonable and at arm's length. The auditor should obtain copies of statutory returns filed with authority like excise, VAT return, and verify as per books. Or like this is a different point. Yes, for valuation of loans and advances, assess the allowance for doubtful accounts. What are my doubtful accounts? What are the, if any loan or if any advances outstanding for a long period of time? Assess whether is it doubtful or is it not doubtful. Obtain an aging report. Based on the aging report, you can discuss if any amount is not received for a long period of time. The same, you may need to create a provision for the same. And if it is any foreign currency loan, the same has to be restated accordingly. For presentation and disclosure, loans need to be classified as security deposit, loan to related party, and other loans. Whether the above loans have also been further classified as just like debtors, secured considered good, unsecured considered good, and doubtful. And for each classification of secured considered good, unsecured considered good, and doubtful, you need to have bad and doubtful loans, provision for bad and doubtful loans separately for each head. Also, for loans, whether separate disclosure has been made for amounts due by directors or or any other related party has to be disclosed separately. As per the recent amendment in Schedule 3, the following also has to be disclosed. The following disclosures shall be made where loans or advances in the nature of loans are granted to promoters, directors, or KMPs and related parties, either jointly or severally with any other person, that are either repayable on demand or which are without specifying any terms. So loans granted to promoters, directors, KMP, other related party, amount of loan, and percentage of the total loans needs to be mentioned. All right. So I think that was it with the balance sheet captions. Moving on to sale, profit and loss captions. To verify whether the sale of products and services has actually occurred during the year or not. The audit procedures that we can undertake is to check whether a single sales invoice is recorded twice or cancelled sales invoice could also be recorded. Again, this is something that we will check at the time of performing risk assessment procedures. So while performing risk assessment procedures, identify if the controls exist or not. Then if the control does not exist, understand and evaluate how it will impact which assertion of P&L item or balance sheet item. In this case, if there is no control and if a same sales invoice can be recorded 2 times, then there is a problem in occurrence. There may also be a problem in accuracy. There may also be a problem in completeness. So that way, risk assessment procedures play a very crucial role before we can move on to the assertions audit. Second, whether any fictitious customer and sale has been recorded, whether any shipments were done without consent and agreement of the customer, whether any unearned revenue is recorded as earned. Again, this can also be done as part of cutoff procedures. Whether any substantial uncertainty exists about collectability. This is because AS9 says that if there is any substantial uncertainty for collectability, then the sale should not be recognized now, it should be recognized later when there is no uncertainty. Whether customer obligations are contingent on other actions. Also review the sequence of sale invoices. Again, this is a basic checking that we may anyway be doing, but we need to now document it and say that this checking we have done to verify the occurrence assertion for sales. Vouch from the sales journal to supporting documents, calculate the ratio of sales return to sale and compare with the previous year and perform analytical procedures. Also, check the sales return with sales invoice, challan, credit note, stock register, and GST, etc. We can verify simply, we can verify the total sales with the total sales as per GST return. The same should always be, I mean, both the items should always be the same. If there is a difference, we can ask the management why is there a difference. Completeness assertion. For completeness, very simple. Like we saw for completeness of debtors and creditors, cutoff procedures are crucial. So if cutoff procedures of sales have been properly verified, then we can check that yes, debtors may also be complete. The completeness assertion for debtors is also satisfied. So perform cutoff test to ensure that revenue are recognized in the current accounting period and sales were not tampered towards the period end. Cutoff errors will usually rise when companies recognize revenue based on date on which the sales invoices are generated rather than the date on which the risk and reward is transferred to the buyer. Auditors will also have to see credit note issued after the accounting period. Many times what happens is that the company will issue sales invoices, just towards the period end, and right after the period end, they will issue credit notes. So as part of our subsequent audit checking, also check the subsequent credit notes that have been issued. All right. Trace from the shipping documents to the sales journal. Check whether quantity appearing in sales journal or not, and check reconciliation of total sales of goods dispatched as per stock records and as per financial records and excise records. So if the factory is maintaining separate records, we need to verify that the goods coming in or goods going out as per the factory reconciles with the goods coming in or going out as per the financial records. Also, we can review the GST return and ensure that the same is reconciled with revenue that is reported in the profit and loss. For measurement, if there are any export sales, consider calculating or reviewing exchange gain or loss arising from the sales. Also, recalculate the prices and extensions on the sales invoices. Trace a few transactions from inception to completion. The auditor must understand client's operation and related cap issues. Compare the rate of sales affected with related party and review them for collectability. Say, as part of section 188 checking whether the transactions with related parties are at arm's length or not, we anyway compare the rate of sales to related parties with the rate of sales to other parties. So that can come as part of measurement for sales of product. Also for presentation and disclosure, this is fairly simple. Whether the disclosure of sales in respect of each class of goods has been made, whether the revenue from operation is disclosed as sale of products, sale of services, other operating revenue. Also, whether brokerage on discount on sales has been disclosed and whether transaction with related party has been appropriately disclosed in the notes to accounts. I'm not covering purchases. Purchases is exactly the opposite of sales because we are just short of time. I'll cover other areas. Purchases is exactly the opposite of sale. So whatever procedures that we performed or that whatever procedures that we undertook for sales, we can also undertake for purchases. Just one thing, for presentation and disclosure assertion of purchases, purchases usually divided into raw materials consumed and changes in inventory. So in raw materials consumed, we record only purchase of opening stock of raw material, purchase of raw material, and closing stock of raw material. There will be a second line item called purchase of stock in trade, which will be recognized separately, and a third line item on the face of P&L, changes in inventories of finished goods, stock in trade, and work in progress, which will be a separate note. Again, whether transactions with related parties are appropriately disclosed or not has to be given out here. Again, case study, we will take it up at the end. For employee benefit expenses, that is nothing but your salary, provident fund expenses, etc. For verifying occurrence, completeness, and measurement assertion, obtain an understanding of the entity's process for capturing employee attendance. There is always a risk that entity could record expenses for fictitious employees. So if employee is recognizing expense for fictitious employees, it may so happen that for fictitious employees, there may be no attendance capturing. But for other employees, there may be. So in that way, we can verify if there are any fictitious employees. The auditor may choose to understand the manner of recording or capturing the time. Obtain a list of employees at the period end along with a monthly movement split. between new hires, leavers, and continuing employees. For a sample of new hires, we can obtain the appointment letter and verify the salary for the first month and subsequent month. For instance, if the employee was hired on 20th of June, then the employee should be paid only for 10 days of June and not for entire month. But for subsequent period, he should be paid for the full month. Similarly, for employees who have resigned, we can verify that he has been paid only till the date that he served. Also, obtain monthly salary register for all 12 months. Compile a monthly payroll reasonability by calculating the average salary per employee per month and comparing it with the previous years. These are just basic analytical procedures which will help us in verifying completeness assertion. Verify if accrual or provision has been made for all employee benefits and obligation, including long-term employee benefits such as gratuity, leave encashment, etc. In case provident fund, employee state insurance fund are applicable to the entity. Just one second. Yeah. Compile a reasonability by applying the rate to basic wages and comparing the amount of recorded liability in the books and analyze the reasons for the variance. All right. So these were the procedures for employee benefit expenses. Again, presentation and disclosure, salaries and wages, contribution to provident and other funds, and staff welfare expenses. This is how employee benefit expense will be disclosed. However, managerial remuneration will be separately disclosed in notes to accounts. So we can verify that whether this has been done or not. Again, we will do the case study later. So what I've done in today's session, I've just covered a few balance sheet captions, not all balance sheet captions, but a few balance sheet captions which will be relevant and material for all of us. Apart from that, like I said, we will do a little bit brief even on audit documentation. It is generally the perception that if it is not documented, it is not done. So as part of our audit, all of you would have realized also that these procedures are not something that additionally need to be done to verify assertions. Oh, assertion audit ke liye we need to do additional procedures. That is not the case. These procedures are something that we have inbuilt and we have already been doing as part of our audit. Just that sometimes there is a breakage of link in terms of linking that with the assertions. So if it is not documented, it is not done. As part of our audit work papers, we need to specify which audit procedure we are verifying for which assertion. SA 230 audit documentation has two objectives: to prepare the documentation that provides sufficient and appropriate record of the basis for the auditor's report and evidence that the audit was planned and performed in accordance with standards of audit and applicable legal and regulatory requirements. This is just a quote from Robert H. Montgomery. The skill of an accountant can always be ascertained by inspection of his work papers. And NFRA, when NFRA had issued a particular initial reports, at that point of time, NFRA had also mentioned, which is also mentioned in SQC, that the auditor's work papers should be such that someone with similar professional background and who is a chartered accountant in practice, just by looking at the work papers, can come to know the audit procedures performed and the audit conclusions reached. So our audit work papers, our audit documentation should be equally very strong. In effective work papers, for our work papers to be effective, you can document the audit procedures which are followed. What was the relevant audit evidence that you obtained for the audit procedures? What were the significant matters which were identified and how the significant matters were solved? What was the discussion with management and engagement team and engagement quality control review? And what were the audit conclusions that were reached? The documentation may be in one or more folders or other storage media in either physical or electronic form, containing records that comprise audit documentation for a specific engagement. In your work paper, along with including other things such as name of the client, which audit period, what is the timing of the audit, please also include what are the assertions that we have verified and what are the audit procedures that we have verified for those assertions. Also obtain what was the audit evidence obtained, who has prepared the work paper, who was the reviewer of the work paper, and what was the conclusions reached. So all this needs to form part of your audit work paper when you when you're documenting the different areas. So lastly, on a lighter note, after understanding so much about what are different types of audit assertions and what all audit procedures need to be done and what all documentation needs to be done, this is just on a lighter note. He's a very young fellow who says auditing, where auditing is not at all stressful. We can conduct it very easily. So I hope this presentation was helpful to all of y'all. And yes, over to you, Anilji.
Thank you so much, sir, for a detailed presentation. We have gained a lot through your deliberation relating to the various audit sessions. I have received certain queries from the members.
Yes.
Hope I am audible to you, sir.
Yes, sir.
Sir, first question is, do we have to mention the consequences in the terms of money for penal action following such holding of Benami property?
Consequential action. So, if the liability is already been determined, then that needs to be recorded as part of a provision for expense itself. But if the liability is not yet determined, then you can obtain a representation that whether this is in the future, if this liability is going to come, then in the details of Benami property, you need to disclose it.
Yes, sir. So, how to test the truth behind the certificates given by the management regarding impairment of the asset?
So basically, what we can do is we can ask the management to ascertain what is going to be the future recoverable amount from the use of particular plant and machinery. When we had such a situation where we wanted to impair, uh, we asked the management, from this particular plant and machinery, you tell us in the future for the next 3 to 5 years how much goods you are going to produce and what is going to be the profitability for those goods, discount it to the present date and come to a number which shows what is the future value, present value of all the future benefits that you are receiving. Compare that with the book value of the assets, and the difference is recognized as impairment.
Yes, sir. Sir, audit assertions with respect to the system audit and software services, as accounting is also digitizing. So, some specific assertions, if any, can you throw light on it?
See, not any specific assertion, but when it comes to system audit, there is automatically an added assertion. For example, nowadays, not all systems no system lets us delete any accounting entry. Even when you delete any accounting entry from a basic software such as Tally, it gets recorded. So the basic assertions will always remain. It is not that just because everything is now digitized, we do not need to verify any assertion.
Yes, sir. Yes, sir. Sir, can company report foreign currency as cash in hand?
If the company has the foreign currency, if the company owns the such foreign currency, then yes, but they need to convert the foreign currency by applying AS11.
Okay, sir. In case the part purchased for old machine and
Mhm.
part is important and costly, whether the same needs to be capitalized or treated as expense, sir.
So if it is a material part for the use of
It is
machinery,
material. Yes,
then it
yes.
will be capitalized, but then it needs to, we need to, for this particular query, just also ensure that the old part for the machinery is removed from the cost of the asset.
Yes, sir. So whether test of balance to be taken is verified by the client from the vendor in writing, it is sufficient.
No, see, because vendor and client can always enter into an understanding. It is always better that we opt in directly from the vendor as part of SF 505.
Yes. So normally lender do not share the lending information without the consent of the borrower.
Right.
As of the country do not permit to such information with the third party. Hence,
Hmm.
borrower consent is must while interacting with the lender. How to deal such situation when borrower not inclined to provide consent for the lender interactions?
I mean, you can take it in writing the reasons why borrower is declining to give consent. But if the borrower declines consent and the vendor is not going to give, it can be pointed out as a modification to the opinion if it is if it is of a material nature.
Yes, sir. Sir, what happens to MSME interest that's accrued in the books? Is it paid to the creditors?
So, you see, if the creditor is claiming the interest from the company, then of course it has to be paid. But if there are some creditors and the company has an understanding with the creditors of not paying, that doesn't dissolve the company of the liability of accruing the interest. The company has to accrue the interest. Then later on, after a period of 3 years, 5 years, if the vendor is not claiming, you can write it back after relevant authorization. But the company still has to accrue interest in the books.
Yes, sir. So one question is relating to your slide number 32.
Yes.
Member is asking, outstanding dues are from the due date. Then where to show the undue balances, then only it will match with the trade payable schedule.
Correct. So I answered that query while explaining only what you
Yes.
can do. You can create one more column not due. So before less than 6 months, create one more column not due, and then the total will match.
Can we add the payment as prepayment for the purchases for which the delivery is received after year end date, or do we show it as a negative balance on the trade payable, sir?
I'm sorry, I didn't get the question.
So can we add the payment as prepayment for the purchases for which the delivery is received after year end date,
Mhm.
or do we show it as the negative balance on the trade payables?
No, you can. We need to show it separately as advance to vendors.
Yes, sir. Yes, sir. Second last question, sir. There is an agreement between a holding company and a subsidiary company for lease of land.
Mm-hmm.
Subsidiary company has incurred stamp duty for the same.
All right.
Whether the stamp duty paid can be part of right of use assets as part of India's 116.
This is something I'll have to read on because it's a very specific query, and I mean I can answer it later on. I'll
Yes,
have to read
yes,
on this a little.
yes, yes, sir. Last question, sir. Is the show cause notice conclusive enough to disclose as a contingent liability?
Not necessary, no. Or if it's just a show cause notice and the management believes that they can easily refute this show cause notice and the possibility of outflow is remote, then no need to disclose that as contingent liability.
Yes, sir. Yes. Now we come to an end, sir. You have taken almost all the queries, and you have covered all the aspects as well as the audit assertions. And we have gained a lot through your deliberation. And on behalf of Auditing and Assurance Standard Board, once again I extend my heartiest thanks towards you for sparing your valuable time and acceding to our request on a very shorter notice for this 112th CP program organized by AASB of ICI.
Yes,
Thank you
sir.
so much, sir. Thank you so much.
Thank you. Thank you so much,
Thank you,
Anil.
sir. Thank you, sir. Namaste.
Namaste.